Welcome back, Alpha Hunters. Okay, so we got a great topic today. It's really about trying to figure out what is the best put option to buy in a bearish move. And two of the main reasons why I want to cover this topic, well, the first reason is because a lot of new traders seem lost as to which option they should look at to buy. Because you do your analysis as a new trader, or maybe you're a trader coming from stocks and then you're trying to get over to the options world, and you do your analysis, you figure out your price target of where you think the stock's going to get to, maybe your time target, and then you go look at the option chain and you got all different kinds of expirations, you got all different kinds of strikes. So we're just going to kind of break it down a little bit, see if we can help you guys narrow in on what you should be looking for. The second main reason is because a lot of other people say hey, just go buy a 0.7 delta option, or just go buy a 0.9 delta option. And then another thing I've seen is to go as far out in the expiration as possible. Well, those are okay tips and tools to kind of at least know which option to go buy specifically, but that's not like the most optimized into getting the best return, the best bang for your buck on a reward to risk ratio. But in the end, the answer just really might depend heavily on what kind of strategy you're trying to do. But for this instance, what we're going to look at in this example is mostly a directional play. Just one put option in a directional move, and that's pretty much it. Okay, so let's get into it. Okay, so in looking here at the stock chart, this is just the stock chart of the SPY, and really the time period of the move that we're going to be looking at, the closing prices for the options of June the 4th, all the way to the closing prices of the options on March the 8th. Okay, so if you really want to see the move, it's from this point all the way down to this point. Okay, so the reason why I'm going to analyze that time period and not this candle right here, which is where the actual low was for the whole move, is because I'm going to be using the Thinkorswim feature ThinkBack, and they only have the closing prices for options on individual days. I wouldn't be able to pull in the prices for this day. It would be the close of this day, which is up here. So I wanted to bring in the option price for the lowest part of this move, which is pretty much here on a closing basis. So a few things to know about this move is that it did last for roughly about 13% move down, and it did last for about 43 trading days. Okay, so let's imagine we were back in December of 2020 and we're doing some analysis, and we think, okay, this is a good spot to get in. I think it'll get down to this price level in the future, and maybe by this date. Okay, we think you can get there by this date. And then the next thing we do is we go look at the options chain, and what we see is, well, we have a lot of expirations here. There's a lot of expirations to kind of go through to figure out, which ones do we buy? Because that's going to be the first part, right? We got to figure out what expiration we want to get to. And then when we do open up an expiration, we have dozens to not hundreds of different options on the expiration of different strike prices that we can choose. And this is where a lot of new traders can be like, I have no idea which one I want to buy, I want to purchase, I want to trade. And then how do we know the one that we're picking is the most optimized for our particular strategy? Okay, so that's what I was kind of wanting to debunk here today. There's a lot of different options to look at. There's a lot of different expirations and strikes. So let's figure out potentially what could be really good area to be buying put options on whatever move we are expecting. So in looking at this move, so I did go ahead and make an Excel file. So I did dump in the January 3rd option chain data from Thinkorswim, and then I also did dump in the March 8th option data from Thinkorswim as well. I think I did mention when we were looking at stock chart, I think I said January 4th, but January 3rd was the day before. It was pretty much roughly the same closing on as far as point wise. So these two tabs that are over here are the raw data, and then I had to make two other tabs just to get them to a little bit more lined up to way I can use them for formulas and stuff like that. And then this is the main tab that we are going to look at. So up here in the top left, we have some basic information just about the analysis and what we were looking at here. So the ticker is going to be the SPY. The beginning date is going to be January 3rd of 2022. The end date is going to be March 8th of 2022. We got some basic info on the stock price for the ending value on the beginning date and the ending value on the ending date, as well as what kind of percent move it was, how many days it took, which was 44 days, 44 trading days that is, and then some notes to know on what kind of options I used. So the options values that I use is going to be the mark for the close of business for March the 8th and January the 3rd. And then the options that are considered are all monthly options that are pretty much after the end date. So any expiration date after this March the 8th, those are the ones that I'm considering in this analysis. Not quarterlies and not weeklies. It's only going to be monthlies, okay? The monthly expirations. And then I excluded any strike during any expiration that do not have any value, okay? So all strikes for all expirations, they need to have value, okay? So if there's a value for the 200 strike for March and April, but there's not any out in the future for the 200 strike, then I would have disregarded it, okay? So I've already cleaned up a lot of that, so you shouldn't have to worry about that. I just want you to know that those are the ones that are excluded, okay? You know, even though I have excluded some, I excluded quite a bit, you still get a great idea as to which ones you are looking for, which kind of price levels you are looking for, and which expirations you are looking for. So if this data is hard to see, and I was kind of going through that, you know, go over to the Discord, open it up, go over to the analysis and data tab, and then down there you will see the best put options for bearish move. That's pretty much this file. And this top section right here where all this data is, this is all the puts. I also did put in the calls down below just to have them there for if you want to do any more analysis based on around calls during certain moves. You know, feel free to use that information as you want. But I mostly wanted to look at put options here and to see what would be the best spots to be doing this. Now, I kind of already knew going into this what options were going to perform the best because I did this analysis back in college. But a lot of people I know didn't do this in college. And this is something that I've constantly, repeatedly kind of talked to new people, trying to help new people into trading. And so I wanted to clear up some of that. And then also clear up some things that you see from other people that just doesn't make sense, not really backed by numbers or anything. They're just throwing something out there, okay? But what you can see is we have a move that lasts for 45 days and it goes down 12.87%, right? I'm looking at these two numbers up here. So if it goes down that much, then obviously the ones that are going to perform the best are going to be the expiration just after whatever the end date is. Those will be the options that perform the best, okay? So if we come down here, we can see that this is the green area. This is the best performing area of all the options that are comparable, okay, in this data set. Now, another thing I've gone ahead and done is on the left side here under this column is I have put an in the money and out of the money percentage, okay? So how far in the money or out of the money a percent from the stock price is this expiration. Now, I did take it off of the beginning stock price value, not the ending stock price value, so just keep that in mind. Don't get confused by that. And what we can see here is we have a roughly 12% move down. And the options that perform the best is this one right here, this 455, which is 5% out of the money. Now remember, the strike prices that are below the stock price for puts, those are out of the money. Any of the strike prices that are above the stock price, those are in the money, and therefore they are highlighted gray, and they have a positive percentage, okay? The ones that are out of the money, they have a negative percentage, and they are not highlighted gray. The sweet spot for this particular move was anywhere between 3% out of the money, 2% out of the money, to roughly 10% out of the money, with 5% out of the money being the best potential spot for reward to risk, okay? Now, what's interesting to note here is how many of us are going to be able to buy the expiration that's going to give us the best return? Well, I'm going to say probably not realistic, okay? So I'm going to leave this up to you. You can use this how you want, but I want to kind of just let you know how this data is laid out. This section over here, this is just basically bringing in the beginning values. And then this section over here, okay, this is bringing in the ending values, okay? I have them marked beginning, ending values. So you can feel free to use this data as you so wish, but just understand that this value is the best performing put option. And then if you go out farther out in the expirational time period, it goes a little bit closer to at the money, but it doesn't really get too far in the money as far as what the best performing put option is as you go out further out in the expirational time period. So I know a lot of people do say to, hey, you know, go to like a 0.7 delta, go to a 0.9 delta. You know, if you have access to Thinkorswim, which you pretty much all can, you can use the software for free. You just got to sign up for an account. You don't have to fund an account. It's through TD Ameritrade. So you can use this data to your benefit and do your analysis, okay? But if you were going to go buy like 0.7, 0.9 deltas, well, they were going to be the ones down here. I didn't bring in that data, but if you wanted to go further into it and go look and see where like 0.7 deltas, 0.9 deltas are, you know, feel free to go to look at that. Now, here's the other thing. If you want to go farther out in time, out into this time period, well, these are some of your worst performing actual put options over that course of time. So buying more time, it doesn't mean better reward to risk, okay? So this is where if you're unsure of the time period that you are looking for a certain move, yeah, sure, go farther out in time. That makes sense, okay? But don't go farther out in time if you don't think you don't need it, okay? You want to stay as close to the time period of a move that you're looking for, because that's where you're going to get the most reward. But feel free to use this, you know, feel free to download it, use it. It's out there for you. So you can use this and look at the put options, how some of the put options worked, and then how some of the call options worked. And you can kind of figure out some pretty good strategies. Just based on this information alone, this is very valuable just to kind of understand which strategies can be very beneficial during certain moves. But I did want to share this with you because this is a big reason why I do buy a lot of out of the money options. Now, I don't go deep out of the money. You know, don't go deep out of the money. If you go deep out of the money, well, you're not going to be performing, okay? So, but if you do go this route, you do want to go a little bit out of the money, but that's why I do typically do that. And I've had people ask me before, why do you go a little bit out of the money? You know, this guy says to go to a 0.7 delta. This guy says to go to a 0.9 delta. And I'm like, have they ever shown you their rationale as to why they go to a 0.7 delta, why they go to a 0.9 delta, why they go as far out in expiration as possible? This is why I do things the kind of the way I do. It's just the numbers tell me that's what I should be doing. Now, here's another thing just to kind of end this on, is this might not have been the best performing option during that time period, right? I told you I got rid of a lot of options of strike prices because they didn't have values all the way through all the expirations. And the other thing is there might have been an option that I didn't include that expired before this March 18th, 2022 expiration period. There is possibly an option that was perfect in how it moved that maybe expired 2 weeks earlier. So this might not be like the best option. You know, this one right here, this 455 strike for that March of 22 expiration might not be the best one to buy, but it's roughly in a really good area for reward to risk and those kinds of things, okay? So just kind of knowing what zone gives you the best reward, well, that's what we're kind of in it for. I'm not in it for, you know, measly returns. I'm in it for, you know, pretty good returns. Feel free to look this over with the puts and the calls down below and see if you can come up with some strategies that have some really low risk profiles and really good high reward profiles. Another thing is when I do hear about people talk about doing a 0.7 or 0.9 delta, you know, when they say that, they're kind of talking like they're owning the stock, but they're doing it through an option. And I don't like to think that way. I do like to think, hey, I'm buying an option, and when I buy an option, I'm trading the option then at that point in time. I'm not trading the stock, because those are two different dynamics. But this is the first part of two parts. I will be doing this again for calls on a bullish move. That'll be part 2 of this little exercise. Alrighty, take care, Alpha Hunters.